This episode of Raoul's Adventures in Crypto is sponsored by Masterworks. The AI boom is here. Or is it? The markets are only surviving thanks to just 7 mega-cap tech stocks. The equal weight S&P is dead in the water, up less than 2%. That's a larger disparity than the dot-com bubble. Billionaire investors like Ken Griffin warned the system was breaking down. But that's why this channel keeps you informed, because some markets are used as safe havens when volatility spikes, and Masterworks gives you access to a market currently surpassing its pre-pandemic levels. The art market. To date, Masterworks has sold over $45 million in fine art, including works by Banksy and Monet, returning the net proceeds to investors like you. Every one of their 13 sales handed back a positive net return. Over 730,000 users have signed up to gain access, so there is a waitlist. But Real Vision reached out about VIP access to their latest offerings, and we have a special link for you. Skip the waitlist and head to masterworks.art/realvisionfinance now. That's masterworks.art/realvisionfinance. See important disclosures at masterworks.com/cd.
The vast majority of, I think, crypto experiments or projects that have launched haven't gotten that right.
No.
I think that we've counted roughly 3,000 to 4,000 projects just within DeFi that have launched since inception, and there may be 5 to 10 projects that actually matter today.
Ben, fantastic to see you on Real Vision.
Yeah, it's really great to be here. Thanks for the opportunity to come on. I've actually been a viewer and subscriber to Real Vision for a while, and I've learned a lot from all the guests on the show. So I'm humbled to be here myself.
Well, a lot of people reach out to me and said, "I've got to speak to Ben." So you can't let me down now. This is going to be a good conversation.
I'll do my best.
Before we start, as ever, I'd love to get into people's journey into crypto. How the hell did you get here? Because you're a pretty non-traditional route in some respects.
Yeah, so I spent the first 10 years of my career in traditional finance. I graduated in 2008, a few months before Lehman Brothers, and worked in investment banking and private equity, and then spent a significant amount of time in the distressed debt and debt capital markets. I was with KKR and TPG. And if you would have told me, during that time frame that I would have left and started a crypto fund, I probably would have told you, you're out of your mind. What is crypto? This is absurd. But I found myself in 2015, I was living in San Francisco, and I was at a dinner party with a number of people in finance and some engineers at Google. And someone posed a very interesting question, which was, if you had to hold one asset for 100 years and you couldn't sell, what would you choose? And I thought it was a thought-provoking question that I had never asked myself. And some people at the table said real estate, others said gold. I heard from someone at the table kind of the term Bitcoin. And it wasn't my first time hearing Bitcoin. My roommate at the time worked at Google. He had been talking about Bitcoin. I kind of heard the term floating around in different conversations, and I never really took the time to dig into it. But after I heard it for the 4th or 5th time, I began doing my own research. And coming from a traditional finance background and spending my whole career in capital markets, I found the exercise of actually digging into what Bitcoin is to be incredibly intellectually stimulating, because despite the fact that I'd worked in finance my whole career, I'd never actually asked myself, what is money? What is money and how does it work? And I think that question of what is money is just a fascinating one. And it really takes you on a journey. And it took me on a bit of a journey back to understanding, from the very earliest stages of civilization, that money was, sometimes it was beads, sometimes it was feathers, sometimes it was cowrie shells. Eventually it evolved into precious metals, and then coins carved out of precious metals, and then pieces of paper redeemable for precious metals, and then pieces of paper redeemable for nothing, post Bretton Woods. So that was fascinating. And, I started buying Bitcoin, and this was in like 2014, 2015. I opened a Coinbase account, and I kind of went back to my day job of, investing in distressed debt. And a couple years later, Ethereum launched, and Ethereum launched in mid 2015. So we're coming up on 8 years of 8 years of Ethereum being kind of on mainnet. And in the early days, there really wasn't much going on in Ethereum. There were maybe 20, 30, 40 misfit developers building random things, writing white papers. But there was one application that caught my eye called MakerDAO at the time, which was this decentralized revolving credit facility where someone could take collateral, put it into a smart contract, and borrow against it up to a certain loan to value ratio, similar to just like a margin loan against a stock. And coming from like traditional debt capital markets and pouring through hundreds of pages of bond indentures and working with legal counsel to interpret different terms and understanding kind of the foreclosure process and how to perfect liens and just the complexity of the traditional financial system, I thought that MakerDAO was, elegant, simple. It was governed by math. It was just software, and it was this global product. And it kind of captured my imagination. And I thought about Bitcoin initially as being kind of this decentralized money, but decentralized financial services are an extension of decentralized money. If you have non-sovereign money, you need non-sovereign financial services. And so that was really like a 0 to 1 moment for me. I was at KKR at the time, and I raised kind of my hand to spend more time on the blockchain space on behalf of the firm, and spent a couple of years doing that. And then at the end of 2017, early 2018, I made the decision to
spectacularly bad timing.
Yeah, it couldn't have been worse timing to start an investment firm in the space. Fortunately, I took a long-term view, but it was tough sailing for a while. Back then, I think people generally in 2018, 2019, wrote off the industry just a bit because there wasn't DeFi, there wasn't NFTs, there certainly weren't networks like Helium. There really was just like Bitcoin, and that was it. And then there were a bunch of other experiments, but Bitcoin was really the only thing that had product market fit. And now I like to say this bear market's a bit more tall. This is a much more exciting bear market despite price action because there's just so much happening in the space. There are 12 or 13 just different verticals, and you could spend all your time on just one of them because there's so much happening. And so it's a bit of a different environment today than I would say it was in 18.
Hi, everyone. It's Raoul, CEO and co-founder of Real Vision. I'd love you to join us over at Real Vision, where you can then experience how we can help you navigate these really complicated times. You see, investing's not an easy journey, but we bring in the world's best experts to help be your kind of advisors in navigating these times. So come to realvision.com/essential and let us show how a Real Vision membership can help you. So what's your investment process at Parafi? What do you guys do? What kind of investments do you do?
Yeah, so we have really 3 different strategies. So we have a token focused strategy where we are looking at liquid tokens, underwriting them similar to the way an analyst at a hedge fund would do fundamental underwriting of a stock. So we're pouring through the 10,000 public tokens, the 1.2 trillion of market cap, and doing kind of deep fundamental and technical research. We're also backing early stage token teams, kind of pre-launch, so developers that have ideas. We're underwriting them. We've done, I think over 120 different early stage token deals over the past 5 years. We're also investing in kind of companies in the space, so companies that are providing kind of critical infrastructure. That's from like very kind of early stages, seed, all the way through to late stage. We led the Series D on Consensus, which owns MetaMask, which is the 56% of all transaction activity on Ethereum flows through MetaMask. So it's kind of the most popular wallet, 20 million users. And then we also have a strategy where we're engaged in just doing things on chain and using various DeFi protocols ourselves, because I think it's important in this space the best way to really learn is to actually use the products and have, I think I've learned a lot just personally from having a MetaMask wallet and testing different things out, testing different bridges, testing different blockchains, testing different applications. And it kind of like gets you very close to the metal in terms of understanding the technology. So we have a part of our team is focused on that as well.
So on DeFi, the user experience is still so bad that, A, MetaMask is not great. B, then, bridges, decentralized exchanges, the complexity of understanding how this all works. What are you seeing in the space of people solving that? Because it feels like a lot of the infrastructure's done. Yeah, the bridges aren't perfect, stuff like that. But it feels like this bull market that I think we've started needs to be led by UX. We need to be able to onboard people easily. What are you seeing in this space? What are you thinking?
My thesis and the short answer is I think that DeFi is going to be a B2B technology and not a B2C technology. So I think that you're absolutely spot on with your kind of comments in that using financial applications, DeFi applications is a terrible UX. It's incredibly complex. You have to understand things like bonding curves and gas prices, and a lot of these applications are you have low security. And so, I think my view is that, look, the majority of there have been roughly 3 to 4 million users that have interacted with DeFi wallets since inception, with DeFi applications. So that's not a huge universe of people, and it's a self-selected group, right? It's the most curious and technically and financially savvy people that have, said, hey, I want to start using these products and putting significant capital on. But of the 8 billion people on Earth, vast majority of them actually don't care about finance and capital markets. They just have very basic needs. They want to save money and spend money, and some of them want to invest money, but they don't want the complexity. And so I think that the majority of users are going to interact with DeFi without ever knowing they're interacting with DeFi. So it's going to be almost like abstracted away. They'll be interacting with a bank. The bank will use Ethereum to settle a remittance, back to their home country. Will use stable coins for B2B payments. Will use stable coins for point of sale payments. Will use for transfer of assets. But it's all going to be B2B. It's going to be banks and fintech companies. And maybe the savvy consumers can use it, but the vast majority will be institutional. And then I think, with respect to gaming, with respect to other verticals within the space, I think those will be more consumer focused, and that activity will generally sit on layer twos. But for DeFi, for finance, that's more institutional.
Yeah, it feels that, you can wrap these products and make them user friendly, but it needs a front end like a bank or a typical kind of fintech app for consumers. Really interesting. I was speaking to some friends in Australia. A friend of mine used to run, I don't know if you know him, Drew Bradford, ran National Australia Bank in sales and trading. He's just retired from there. And I said, what have you been up to recently? He said, oh, we've been building stable coins. I'm like, really? Why is National Australia Bank building stablecoins? He said, we've done them in 5 different currencies. I said, why? What are you doing? He's like, and this really was a light bulb moment for me. He's like, US equities are going to T+1 settlement. We're in Australia. It's T+2 or T+3 for FX. He said, we can't settle any equity trades. So we either have to give brokers massive amounts, hundreds of billions of dollars as a cash advance to settle, or we need to figure out different settlement rails. And it's like, yes, stablecoins can be a consumer app, but this is an infrastructure that I hadn't even thought about.
Yeah, I mean, it's fascinating. I mean, just the settlement process alone has been across like currencies, fixed income, equities, commodities hasn't really evolved much. You have like, banks that each have their own like database of what they own and reconcile it at the end of every day. And I come from the fixed income market, and distressed trades could be T+20 to settle. I mean, it's incredibly inefficient. And one of the, I think one of the most amazing things about digital assets is as bearer instruments, like the trade is the settlement. There's no trade and then you settle later on and it gets reconciled. Like the trade is the settlement. So I think that unlocks, a significant amount of efficiency.
Yeah, I mean, when I first saw Bitcoin in 2013, I'd just gone through the European crisis and the financial crisis, and the understanding that nobody owns anything in the financial system because of the rehypothecation. And then, when I was at Goldman, there was ISDA docs stuffed under desks everywhere. Nobody had a clue all the derivative stuff, who owns what. And I just saw the blockchain. I thought, oh, this is obvious. This is where it all needs to go, because then you've got instantaneous settlement and ownership of everything.
Yeah, I mean, I think that's, it's interesting because if you looked at, Lehman Brothers 10Q, the last 10Q before they filed for bankruptcy, and you tried to figure out like what risk they owned, and you poured through footnotes and you poured through, all their disclosures, like it was still like impossible to tell. And like that opaqueness in the financial system was, I think, one of the reasons why we had a financial crisis. Like, I think we can agree that like transparency reduces risk. If you can see the underlying risk in an application or network, it allows you to underwrite it more accurately. And same with we just saw this like play out with the regional banking crisis, where people just didn't have visibility into the solvency of different regional banks, and as a result, people were like, "Well, I can't underwrite the risk. Well, I'm not getting really paid to take risk. I'm just going to, redeem my capital and move to, one of the big four banks." So one of the things that's fascinating to me about the space in DeFi is just, I can look at MakerDAO or Uniswap or Compound or Aave and see every single lender, every single borrower, the exact price they get liquidated. I can see their entire repayment history. I can see other assets in their wallets. To understand other types of collateral they can post. I mean, the degree of transparency is actually like completely unprecedented, in capital markets. And I think just from first principles is just like, it is the building block of, I think, like a better underlying system.
Yeah. And the other thing is, I grew up in the investment banking side in the derivative markets. And the other thing is, all derivatives are basically just smart contracts, particularly any OTC derivative. We have any funky term in it. It's basically easily done as a smart contract, and so much more efficient, so much cheaper, so much faster. So, it's less exciting to many, all of these kind of infrastructure things, but the use case is just stupendously big. I mean, the OTC derivative market's $1 quadrillion. Now, yes, It doesn't use that much activity on chain, but it uses a lot. So these kind of things, even though they're not consumer facing and obvious, they're just absolutely gigantic.
Yeah, and what's interesting is like legalese, like all the language that will go into an ISDA, will go into a credit agreement. To your point, it is just code. It's a series of if-then statements. Because if you think about like just an insurance contract, if event happens, pay party B, X dollars. These are just, it's logic that you can program into a computer on a blockchain, and you can have it execute logic for you instead of paying custodians, broker dealers, clearinghouses, collateral agents, servicing agents, the kind of very complex supply chain of capital markets today, which, by the way, has just increased in complexity, has only increased in complexity over time. And the other really amazing thing about DeFi applications in replacing legalese with code is that legalese can have different interpretations by different people. And so then you end up going to court, right? Because you say, hey, I interpret this clause a bit differently than you do. There are millions of dollars on the line. But the great thing about code is it's unambiguous. And so, it becomes like the law effectively within DeFi. And, it is a greater burden of responsibility for participants if you can't go to court, which is part of the reason why I think ultimately the users will skew more towards, the largest institutions that will have, people that are able to enter into these contracts with sophistication.
So let's zoom out a bit from DeFi. Where do you think we are in the cycle now? And what is your thesis for the next few years? Yeah,
so look, we're 14 years in to this industry, and over the past 2 years, so in 2021 and 2022, there was just a surplus of capital that came into the space. So if you kind of zoom out over 14 years, there was $85 billion of venture capital that entered crypto. But in 2021 and 2022, there was roughly $60 billion of venture just in those 2 years. And there were a number of companies that got funded to build things. A lot of them still have runway, although you're starting to see, I think, firms and companies start to, need to kind of go back to investors, raise down rounds, return capital, get acqui-hired. So we're starting to see consolidation, which I ultimately think is a healthy thing. And that is, and I think it kind of is reflective of how the market cycles go in crypto. In bull markets, you see human capital come into the space and financial capital come in. Some of that human and financial capital leaves in the bear market, but there's a critical mass that sticks. And there's a critical mass that ends up building things, tools, infrastructure, applications that have product market fit. So I think we are, in terms of precisely where we are, I do think we're, I think we're either, I think we put in the bottom just, in November in terms of price is my sense. The market has had just an incredible dose of bad news over the past, since FTX, but prices are higher. If we go back to November 1st, FTX filed for Chapter 11 on November 7th. So November 1st, right? So we're 7.5 months later. If I would have told you on November 1st that over the next 7.5 months, FTX would file for bankruptcy, Genesis, the largest institutional lender, would file for bankruptcy, we'd have a regional banking crisis in the US, SEC would be suing Coinbase and Binance, and and then beyond that, the other large graveyard of other events and negative things that have happened in the space over the past 7.5 months. If I would have said, hey, all of these bad things will happen, but prices will actually be higher on Bitcoin and ETH, you would have said, you're out of your mind. That just can't be. But I think when markets, I think prices are a source of truth, and they're kind of one of the purest sources of truth. And I think it's kind of reflecting. It's been a bit of a narrative violation, and so when the markets aren't reacting to bad news anymore, I think that's generally a positive sign. I think a lot of the forced selling, BlockFi, Three Arrows, the deleveraging that we saw in the middle of last year, I think a lot of that's done. And, we're now really consolidating. And I'm particularly encouraged by the news of the past few days with the large number of institutions that have come into, have filed for spot Bitcoin ETFs.
Somebody's been told something, right?
Somebody knows something. BlackRock was the first, and then, you had you had then Invesco and Wisdom Tree. And, that also came, on the back of that, the news came out that, Citadel and Virtu and Charles Schwab had backed a new crypto exchange. I mean, somebody knows something. But I think that's all very encouraging, right? And I do think that you kind of I was listening to an interview with the BlackRock COO from this past week. And, they're fascinated by stable coins as a technology for kind of frictionless payments. They're obviously, very interested in Bitcoin as it's grown as a more relevant asset. It's a $500 billion asset. And then they're also fascinated with and making, have internal initiatives around tokenization of real world assets. So I think look, real estate, carbon credits, fixed income, I think it's inevitable that we see the $600 trillion of global assets become tokenized, because to our earlier kind of comments, it does make settlement just much more efficient. It standardizes the format of these assets. Because today, I mean, if you look at just assets, they're sequestered on different databases like DTCC. They're segmented by geography. They're sequestered in these legal agreements, and these don't actually talk to each other, right? People have PDFs saved down to their desktop of legal agreements, but they're not interoperable. And so you can't use private assets as collateral. And in the 90s, when the securitization market took off, one of the big breakthroughs was there were QSIPs, right? There were these 9-character alphanumeric codes that could get attached to any bond, to any fixed income security, and it standardized the format. And so then capital allocators could basically securitize debt and invest more programmatically. And so I think the tokenization of real world asset theme is I think going to be a big one in the coming quarters. You saw KKR tokenize LP stake in one of their funds. You're seeing Apollo tokenize debt in emerging markets. You've seen Hamilton Lane tokenize a money market fund on chain. So
we saw the European Investment Bank, the EIB, tokenize a bond. And that was 2 years ago. So it's super interesting to see.
Yeah, I think it. I mean, I think it's I think it's interesting to see this activity after all of the publicly visible failures of last year. I mean, one of the things that the BlackRock COO mentioned is look, he said, we've been monitoring crypto and blockchain for many years, but we kind of put it on the shelf, and it wasn't until the Ukraine-Russia conflict earlier this year that they kind of took it off the shelf, because they realized just kind of the inefficiency of the SWIFT banking rails. And so they decided to get into this business and start this business in 2023, which I think is fascinating timing and a bit of a narrative violation from the average person looking outside in crypto today, which they think, hey, this is the industry is kind of going sideways, but in fact you're seeing you saw the biggest asset manager in the world enter the space today.
I get to speak to a lot of these people, and obviously Fidelity's done an astonishing job. They've got a huge team building out all sorts of stuff just quietly in the background. Franklin Templeton, I mean, who'd have thought that? But they've tokenized money market funds, and they've got a big team. There's the whole industry's focused on this. Goldman's got a team, JP Morgan's got a team. So there's, as you say, it's a narrative violation, because everyone's like, crypto bad. It's not. And there's something weird going on with Gensler, the SEC, what they're trying to do. But clearly, I think he's under political pressure to allow something to happen. And so Bitcoin's the easy one, and the ETF's the easy one. So we can say, I'm not trying to destroy everything. I just want to, destroy some things. So we'll say, but very fascinating as well that they're using Coinbase as part of it, which is another weird twist in that tale.
Yeah, it is. And they filed this after the SEC's lawsuit. So it is interesting. It'll be It'll be interesting to see what happens with Gary Gensler. Like, he still has 3 years left on his term, April 1st, 2026. But my spidey sense says that he's not going to last that long.
No, it feels the political pressure's rising fast, which is why I think he went to BlackRock and said, listen, if you want to do it, we'll let you do it. You know, it feels like there's some acquiescing. My view on this has always been is that when you deal with trained negotiators like governments, they start with no, hard no, never, we're going to never do anything. And then there's the crypto crowd who are like libertarians, like, we want to do anything we want and you can't touch us. And what you end up doing is trying to find how close to the middle ground you get. And that's what Gensler did. He just came hard no on everything. And eventually, whether it's via the courts or via political pressure, they'll end up finding some line. And, you know, it helps that the UK and people like that are being pretty sensible about this.
Yeah, I mean, I think looking globally, like it feels like people talk about regulation and like really you have to go like geography by geography, but the US is, you know, feels like it's almost like the worst geography to be building or launching a crypto project today. But, you know, like I'm always reminded that, you know, the US is like 4% of the global population, 20% of global GDP, and actually only has 10 to 20% of crypto trading volumes in the US. You know, 80 to 90% are outside the US. Only a third of crypto developers are in the US. So, you know, underwriting just a pure ex-US thesis around Web3, you still have a massive TAM. You still have a massive opportunity. Not to mention that, you know, a lot of these applications, like they resonate more with people in countries where there's a less stable political regime or less robust capital markets. And the US is the most stable, has the most robust capital market. So look, I think the US will come to its senses. That's my hope. In the meantime, I think there will be a little bit of a brain drain to places like Hong Kong, the UK, Singapore that are saying, hey, come build here. We'll help you. So it'll be interesting.
So, what else in Web3 gets you excited? Where are you thinking of allocating capital? You know, whether it's in the listed markets or whether it's in, you know, the VC side. What interests you in VC in Web3 outside of DeFi?
Yeah, so I think like I kind of like look at you know, our focus as really being this idea of tokenized real world assets trading and moving on blockchain rails through permissioned smart contracts. So we're investing in infrastructure focused on kind of tokenizing the real world assets, and then the smart contracts that perform financial logic, whether it's trading, insurance, payments, remittance, lending, borrowing, all the things you can do in the financial space. And my sense is we're starting to see a big shift in the market from permissionless contracts to permissioned contracts. So the first generation of DeFi, you know, anyone could use any application without KYC AML, without login, without their IP address being censored. And I think that was like all well and good, but it didn't really scale to a global audience. And it doesn't make sense for institutions that want to know their counterparty, want to know their transaction. And so what we're starting to see now is more KYC'd smart contracts where you can have two parties that engage in an FX trade. And actually, JP Morgan just did this with the Monetary Authority of Singapore. And both contracts were whitelisted for users, for both of those parties. So it was a bilateral agreement. And they both could say, hey, we know who our customer is because we're interacting with like a very specific contract. So my sense is, you know, all the infrastructure that's been created in the permissionless DeFi world, Uniswap, MakerDAO, Compound, is basically getting duplicated, but created in a more permissioned format. So I think we'll see DeFi that is only available to qualified purchasers, DeFi that's only available to qualified purchasers in certain countries. And you'll see kind of financial activity take place on those networks. So we're investing in that infrastructure, the identity layer behind that, because smart contracts basically will need to understand who's interacting with them. And then we're continuing to invest significantly in infrastructure. And, blockchains are incredibly difficult to use. And ultimately, I think for financial applications will really be institutionally used. And so products that allow institutions to custody, trade, interact with applications in a secure way without taking bad actor risk, without taking rogue trader risk, and with getting like the security guarantees they need are incredibly important. So that's been the majority of our focus. I think in today's market, today's market's fascinating within the blockchain space because we've seen such a meaningful valuation reset. 18 months ago, seed valuations were 30 to 50 million. I would say today they're, 7 to 15 million. Series A valuations today are 40 to 60 million. Series B are maybe 100 to 200 million. So we've just seen I would say a 50 to 80% reset in where new opportunities are pricing. I would say later stage opportunities are just not getting done because companies don't want to raise down rounds, and those businesses tend to be better capitalized. And you're also seeing just a huge secondary market emerge. So, the largest crypto venture investor in the world over the past couple of years was FTX. They made 552 crypto venture investments, about like $5.5 billion of cost. And those assets are getting sold out of that estate to various buyers at meaningful discounts. And same with Celsius, same with Voyager, same with BlockFi.
It feels like a lot of that discounted secondary is a great opportunity because, as you said, there's a lot of buyers who need owners who need liquidity, who've got into the round back in 2021, and they want to get out. And this stuff is going super cheap in pretty much every business, right?
Yeah, it's indiscriminate selling across the board. You also saw this with like a lot of the tourist capital that entered the space in the last cycle. The non-crypto native capital, they're now out, and they're actively looking to, like, a lot of the large hedge funds, crossover funds that kind of were dabbling in crypto with 10, 20% of their time are now kind of looking to divest those assets as well. And then there's employee secondaries, which I think have like really taken off. Like a lot of these companies, if someone joins a company in 2018 and has now been there for 5 years and is having life events, is buying a house, needs liquidity, and so those are happening in this market as well. So I think that secondary opportunity set is cannibalizing primary markets a bit, right? Like if I can buy stuff in secondary at meaningful discounts, it's probably more, oftentimes it's better risk return than just investing in something new that doesn't have product market fit.
No, but it doesn't bring new capital into the space. So it's just a revolving of who owns the opportunities in the space, and it's a good thing. You take it out of weak hands, put it into stronger hands, and that means that a lot of people can get access to capital later because they've got the right people who are the holders. So I think it's pretty good. The other thing, it was interesting, we talk about the permission blockchains is, having spoken to a whole bunch of people on this, I think there are some giant pools of capital, the Apollos of this world, the KKRs, the BlackRocks, the banks, who really want to use DeFi because they can lend money into those markets. There's a lack of liquidity in crypto. If you look at the entire size of the hedge fund market, the entire thing is $10 billion. It's minuscule when it's 3 trillion. And that's not the VC side, that's just the liquid token side. And it's 3 trillion in traditional markets. And so it's starved of capital, really, and of sophistication. Yes, there's sophisticated individuals, but not many sophisticated participants. But it feels like these guys really want to put capital into the space in the borrowing and lending markets. Because, as you know, from the difference between that and a distressed debt or high yield is nothing, really. It's the same kind of game.
Yeah, it's really fascinating. Just like think about just like the market size today. Like crypto is like $1.2 trillion asset class. Bitcoin's 500 billion. So that leaves you with 700. Ethereum's 250. saying you have 450 left. Stablecoins are 150. So you really have like $300 billion, which is the liquid value of pretty much every token in the space, every project. And when you kind of put aside things like Doge or the meme coins, the entire market cap of crypto is like at parity with Stripe, like the largest private fintech company in the US at their last round. Like we're not talking about a big market here. And to your point, there's not much liquid institutional capital that's underwriting these names. It is very much like a frontier market. And I like it that way because I think there's just a lot of opportunity. There's a lot of return dispersion.
Well, there's a lot of alpha because there's no capital. You've got no competition for capital.
Exactly. It's the empty room theory where it's like if you're at a conference and you're meeting with a management team and there are like 50 other institutional investors in the room, it's probably like too late. There's no real alpha there. The eyeballs per opportunity ratio is too high. But in crypto, like no one's like really like talking and meeting with like the dev teams around like majority of these like DAOs and DeFi applications, NFT applications. It is like it's like kind of going west on the Oregon Trail into like just like farmland and like setting it's completely uncharted territory, which is what makes it exciting. That's where all the alpha is. I mean, I come from the traditional finance space, like just calling like quarterly earnings, like the amount of energy and money people spent to get an edge, putting satellites above, Best Buy parking lots to predict same store sales and get an edge on earnings, like alternative data. I mean, there's just so much focus around like every metric of like the largest companies ahead of earnings and between quarterly calls. And in crypto, it's like, first of all the data is like real time. You can see it all on chain. You can dissect it. It's like getting a new report from a company every 12 seconds that a block clears on Ethereum. And you have like very rich on-chain data that you can dissect and look for trends within users, retention, everything, volume, earnings. You can run like discounted cash flows on this data. So it's very data rich and no one's looking at it. So, and it's a small market at only 200 to 300 billion when you really drill down. So, I think there's tremendous opportunity there. And what's the other thing about crypto that I always find unique is like people like have trouble bucketing it. Like, is it VC? Is it hedge fund? It's these kind of smaller cap or mid cap liquid tokens are a bit orphaned in terms of like who the natural pool of capital is to buy them. So that again is just like an opportunity. Yeah,
I a while ago set up an asset management firm, which is a fund of funds that invest in digital asset hedge funds called Exponential Age Asset Management. Because the thesis is exactly this, is there is so much alpha because there's so little capital in the space, yet so much complexity and with volatility. That's like a dream from a hedge fund person like me. That's a dream. Volatility and complexity with a secular trend behind it. And I think, hedge funds, I'll be going to be very interested to see whether hedge funds outperform the VCs in the next cycle. And my guess is they will, because VC got more crowded. 60 odd billion is a lot to stick into a small space. While, as I said, the entire hedge fund space is 10 billion.
Totally. And if you like just I was thinking about the math the other day. So like if that's 60 billion, let's say it bought 10% of ownership in the companies that it invested in. So that would be $600 billion of like private company kind of market cap or value. And if that's going to create a venture scale return, it has to go up, let's say like 3x, right? So that means that cohort of 600 billion has to become 1.8 trillion, which is greater than the entire crypto market cap today of 1.2 trillion. So I find that to be a little bit difficult to believe. And as I look at the space today, the largest, the only, I would say like successful public company in all of crypto today is Coinbase, and they're worth $12 billion, which, by the way, like feels like it's being overly penalized by the market. But if that's the biggest at 12 billion, I find it very difficult to understand how that 2021, 2022 vintage is gonna like generate like real venture scale returns, which kind of brings me back to I think the liquid markets are interesting, and you see projects that are trading at seed stage valuations that actually have like real product market fit, real users, some smart contract earnings. And I think that liquid markets are just fascinating right now.
And when you think of your bigger thesis that everything gets tokenized, so the entire financial architecture and infrastructure gets tokenized, where does that value accrue? Is that ETH mainly, you think, or are there others who are going to be, in terms of layer ones or even layer twos, outside of the DeFi protocols and stuff like that, but in the broad sense of investability, where do you think it accrues to?
Yeah, I think a lot of it accrues to Ethereum and the corresponding layer twos is my sense. I mean, look, like I in the last cycle there was there were so many Ethereum competitors that have kind of like slight technical improvements that were arguably more performant. But in this past cycle with layer twos, I mean, layer twos are just incredibly efficient. Someone sent $1 billion on Polygon the other day, and it cost 3 cents, and the transaction settled in 0.25 seconds. Like, when in the history of modern capital markets have you been able to send $1 billion for a few cents in a quarter of a second? Like, that is just transformational. And that's the kind of thing that I think it's like tough to look at something just as simple as that, right? Stablecoin sending on Polygon and not be bullish on this technology transforming the financial system. It just the UX just needs to be improved. We need a bit more regulatory clarity, but not to digress. Like, I think that, you're seeing much more now with like layer twos being cheap, performant. There's less of a reason to launch an application on alternative layer ones. And we have seen a bit of like a recapture in terms of developer activity, smart contract activity, teams building on Ethereum or Ethereum compatible blockchains. And most of it's on layer twos. Like, we're seeing a lot of teams launch applications, not even on ETH mainnet. Launching it instead directly on a layer two, because that's really where the majority of users are. I mean, just over the past week, there have been more users on Arbitrum than there were on Ethereum, more transaction activity on Arbitrum than Ethereum. And that's just a single layer two. So I think that Ethereum is likely where a lot of this value is going to accrue, the layer twos, the bridges, the infrastructure that supports institutional usage of these blockchains, as well as a lot of these DeFi applications that are now pivoting and moving towards more permissioned services and collecting fees based on usage of their application.
The other thing that I've been thinking about, and I see a lot of people who come through here in the Cayman Islands, and talking to them, the big layer ones, I'm like, unless humans are pretty simple. You need a narrative, right? The whole world runs on memetics. And if you kind of know what Ethereum is, you kind of know what Bitcoin is. And for any blockchain to stand a chance, it needs to be thought of as the blockchain of something. Because if not, it's just another blockchain, right? There's millions of the things. And you don't need to use the optimum technology, because people will tweak by building layer twos or layer threes or all the stuff on top. So I kind of look at the world in that perspective, and the only one that I see that has built a larger perspective is Solana, which feels like it's the more retail blockchain, feels more friendly. It feels like, if there's somebody who could own that space outside of Ethereum, could be them. But beyond that, I'm still struggling to see where, outside of, as you say, DeFi or small stuff that has a specific use case, I'm struggling to see how we can have 10 layer ones.
Yeah, I think we're probably going to have a small handful. And maybe we'll have some like very application specific layer ones, but I think like a great analogy is, like languages in the world. Like the top 5 languages are spoken by something like 92% of the global population: Mandarin, Hindi, English, Spanish, and Arabic. So, and then the final 8% is just like long tail of like languages that are slowly kind of like dying a bit, but really you have this like kind of power law distribution. And I think you see that in, so I think that like, you don't need so many, and there are massive network effects. Like if you're going to build a business or launch an application, you want to leverage all the infrastructure, all the developer tooling that already exists. Instead of, if you're opening up a hot dog stand, you don't want to do it in a city that no one's living in. You want to do it in the city that everyone's, you want to do it on the street that everyone's walking down, which is why people want to launch on these on layer 2s and on Ethereum today, and on Solana. I think Solana is probably the other one that has like very meaningful number of users. I think at the end of the day, we may not even think about the world in terms of like what blockchain is this happening on, because I think a lot of it's probably going to be abstracted away anyway. You're just going to like use an application and it'll get cleared on whichever blockchain is the fastest or the cheapest in that moment. But right now we think we have to think about these things.
Yeah, because I mean, like you and I are on a call now. We're using a software system of which neither of us know. You're using some rat phone line, some data source, some computer. I don't need to know or care about any of it. I just click the button and Ben's there, and that's what we'll get to with all of this. And nobody cares what, phone company you're using or what data source, whether it's fiber or whether it's a copper cable. I mean, nobody cares.
Nobody cares. Yeah. It's like, when I send an email, I don't think about using SMTP. I just hit send on Gmail. So like there's Gmail, there's like Microsoft Outlook, there's Yahoo Mail, but no one thinks about SMTP. There are these like applications that have abstracted away the complexity, and no one thinks about the complexity. No one really cares about the complexity. I mean, even people in the financial services space like don't really understand how security settlement works, nor do they care. You don't really need to know to be a successful investor. You can just kind of like, pick stocks or pick bonds, and, it kind of just like works. It can be improved. It can be made more efficient. But yeah, I think it's spot on, which is, we kind of say it's like kind of, there's this term we use like the DeFi mullet, which is, fintech Web2 in the front, DeFi in the back. No one really, understands DeFi or needs to understand blockchains, and it should all just like really feel like a Web2 experience. And I think we're moving that direction.
There's another few areas that feel like they've not yet been captured. Obviously, everybody's trying to fight for gaming to see whether gaming can come on. And I think the other one is kind of music, video, the larger file size stuff that needs to happen at some point. So it feels like there's still some big spaces that have yet to be defined that are quite interesting. It'll be interesting to see where that develops.
Yeah, I mean, I think that, gaming, huge, massive market, it just, intuitively makes sense that people would want to, own the value that they create through playing games instead of it living within a game. And so I think it's just a matter of time before we get there. A lot of the blockchain games that have been developed just aren't that fun to play. And I think that, where I'm kind of interested at the intersection of gaming and crypto is in more just like the classic games, things like chess, checkers, backgammon, games that have been popular for thousands of years. So you're not taking any like gaming risk, but you're able to move the experience of kind of the community around these games and playing these games like into more of like an online format where you can collect rewards or have tournaments online or have NFTs and interact with different communities. I think that's fascinating. But I do think it's like that area is quite interesting. And the other fascinating area of the space that we're seeing like a lot of interesting experimentation is in kind of the token incentivized physical infrastructure network. So things like Helium or Hive Mapper or Demo, where think places where you can kind of attach a device to your car and submit data to a network, or attach a camera to your car, and as you drive around, it kind of basically builds like an equivalent to Google Maps that has more real-time information and data. I think the ability to kind of use crypto to bootstrap CapEx spending across a physical network is fascinating. I think Helium's been like kind of the first like major experiment at that. I think most of these attempts that haven't been able to figure out kind of like how to build sustainable unit economics.
Yeah, that's
the token price.
Yeah, the issue is building an economy that's open. That's why Reddit have been really clever building a closed economy first, because the hard thing is capital flight, right? People cash out. So Stepan had the same problem, is if you're not careful, everybody cashes out. So you need to create a good, deep economy where there's demand and supply for stuff. If you crack that, it's a big deal.
Yeah, no, absolutely. I mean, that is the tricky part, though. I mean, the vast majority of, I think, crypto experiments or projects that have launched haven't gotten that right.
No,
I think that we've counted kind of roughly 3,000 to 4,000 projects just within DeFi that have launched since inception, and there may be 5 to 10 projects that actually matter today, that actually have product market fit and staying power. The rest couldn't get their token economics right. They couldn't, acquire users, and the project kind of these projects will wither away. But if you can get it right, I think that's what it kind of comes down to. You actually have to provide a service or build a product that people organically want to use absent a token. Maybe the token can accelerate your growth or reduce your marketing spend or kind of gamify an experience, but it can't replace the core kind of reason to exist of these applications.
Yeah, it can't just be about getting access to a token. It's got to be, as you said, a behavioral incentive system. We know it works. Loyalty systems have been around for a long, long time, and it works. We just need to figure out how to do that well. And I think I'm working on a couple of projects for that, and we're looking at it for Real Vision as well. How can we embed a token incentive system that is not an open economy for starters, just to create internal money essentially, or an internal system of value? I think a lot of people will move down that route. I think it's pretty interesting. So, final question for you: what keeps you up at night right now? And for me, it's actually that this market moves faster than expected. I kind of think nobody's got their shit sorted out yet. Everyone's been retooling businesses, getting everything sorted out. I actually fear the upside because it could happen a bit faster than anybody's ready for, even the institutions. Which is a bizarre thing, but that's my fear. What do you fear?
I feel like my stomach lining is so thick after all these years of volatility and, just different various negative events in the space. I think if I were to say what do I fear? I mean, I fear that, it just takes longer than I'd like it to for this for the world to kind of move onto these rails. And maybe it takes longer because of regulatory headwinds, or just we don't get the UX right as an industry. But I just think it's a matter of it taking longer. I know to me, this is inevitable. I think it's always, the time scale has always been the difficult thing for me to predict, but I know it's inevitable. I think that the other thing that maybe keeps me up at night more short term is, I think just this is maybe a bit more micro, is a lot of these DeFi apps and DAOs that were started in the last cycle. It's tough to actually, one of the big issues in the space, it's tough to get people to actually stick around. Because if you think about private companies, you have a founder and a VC, and they link up together, exchange capital for ownership, and you build for 10 years before going public or an M&A event. You can't sell early. You can't disengage early. Or you can, but then, someone takes over your place and you don't invest into your equity. But in this space, like, there is a lot of short-termism. And you have a lot of people that built things that maybe got rich in the past cycle that have kind of vested and are disengaged. And there's no board of directors of a DAO to like come up with an equity incentive plan to like compensate the next generation of developers contributing to the DAO. So you're kind of relying on, you don't really have strong incentives, I think, after a period of time for a lot of these DAOs to continue to see like a lot of development activity. I think that's like a big issue in the space. But look, like, I think these things can get fixed, right? Like, with
it's kind of your job as a VC to help these companies when they're building to say, look, think about this. I think a lot of people will be grateful for the advice because you kind of sell a bunch of tokens early and people leave. But really, if you actually stick around, you can make a lot of money if it's set up right.
Totally. And it's really fascinating. Like in the past, like the standard vesting schedule was basically time-based. It's like, hey, you're vesting your tokens over 2 years or 3 years, right? But what we've started to see and push for is performance-based token vesting, whereby, if a project hits certain TVL thresholds or certain user thresholds or certain price thresholds for prolonged periods of time, then teams vest into their tokens rather than just time, right? Because time doesn't really like align incentives quite as well. The beauty of this space is you can program these vesting schedules into the blockchain because you have Oracle, so you can reference these metrics and you can like actually enforce them on chain. You don't have to like trust someone that they're going to interpret a metric the same way that you do. And so like blockchains are actually like incredible systems for designing better financial incentives versus, just like legal agreements, which is what you have at most startups today. So look, like, I think these are all solvable problems. We just have to, we just have to continue pushing in the right direction.
Super clever idea to have the smart contract with the vesting schedule. I think you're right. I think if you can invest into a growing business, then you don't have the dilution effects really because the economy's thriving. If not, people just keep selling and selling and selling, and it just doesn't work. Ben, Listen, fascinating conversation. I think it's going to be a very interesting few years, see what lies ahead. Let's see how your core thesis about the permissioned blockchains, how the institutions come into the space and how DeFi operates. I think that's a really interesting angle. And I think knowing from what I know from the financial markets, I think a lot of people are going to be interested. So it should be interesting times.
Yeah, definitely. I mean, look, thanks again for having me on. Really appreciate it. Big fan of Real Vision. And let's see how things play out. But it's definitely an interesting time to be in the space.
Fantastic. Thanks, Ben. Okay, I thought that was fascinating. I'm not much of a DeFi guy, but when I first saw blockchain, I realized it was going to completely absorb the entire financial system. And Ben seems to be very focused on that same thesis. And it feels that it's getting closer and closer as many more of these institutions come into the space. Stuff like the permissioned smart contracts and lending protocols, that becomes very interesting because it means that all of the big players in the world, these massive trillion-dollar pools of capital, can get involved. And I think that is a big step forward for the space overall. So, look, I thought it was a really interesting conversation and something we should keep our eye on.
Hey visionaries, thank you for tuning in. For more free crypto content like this, head over to realvision.com/crypto. You'll get early access to the most brilliant minds in the space to cut through the noise, get in-depth analysis, and get you ahead of the curve with unbiased insights.
This episode of Raoul's Adventures in Crypto is sponsored by Masterworks. The AI boom is here, or is it? The markets are only surviving thanks to just 7 mega-cap tech stocks. The equal weight S&P is dead in the water, up less than 2%. That's a larger disparity than the dot-com bubble. Billionaire investors like Ken Griffin warned the system was breaking down. But that's why this channel keeps you informed, because some markets are used as safe havens when volatility spikes, and Masterworks gives you access to a market currently surpassing its pre-pandemic levels, the art market. To date, Masterworks has sold over $45 million in fine art, including works by Banksy and Monet. returning the net proceeds to investors like you. Every one of their 13 sales handed back a positive net return. Over 730,000 users have signed up to gain access, so there is a waitlist. But Real Vision reached out about VIP access to their latest offerings, and we have a special link for you. Skip the waitlist and head to masterworks.art/realvisionfinance now. That's masterworks.art/realvisionfinance. See important disclosures at masterworks.com/cd.